we explained the definition of bond, that a bond is a debt instrument that establishes a relationship between the borrower and the lender. These debt instruments requires the bond issuer to repay the amounts borrowed. The bond issuer is the borrower. A bond, a debt instrument that requires the bond issuer, that is the borrower, to repay the amounts borrowed plus the elements to the lender over agreed specified period. This last week, we look at the characteristic of.
So please, we can't hear you. You're breaking up.
Temporal glitch, but I'm back. Now, please, I will appreciate students to confirm if you are not hearing me and there's a break in communication. The only reason why you are going to have break in communication from the lecturer is that all the students will not hear you. If all the students confirm that, sir, the communication is breaking, that means the problem is from the lecturer point. It means the problem is coming from the lecturer network. But if a particular student is having a problem of network breaking, and then that means the problem is from that student network. That was why I was asking the class. A student complained that you are breaking up. And within my network, I can see my reception showing full 100%. That was why I was trying to ask that another student should confirm if you are also experiencing this network fluctuation. That is, communication is breaking.
Communication.
Apparently, Ufoma, I cannot even hear you.
Hello, sir.
Yes.
Good evening, sir.
Yes, who is speaking?
Is Ufoma.
Yeah, I can hear you now.
When you started, the network was really very bad. So when she said the network is breaking, it was really true.
When she said, hello?
Hello?
Please, can you hear me now?
Hello? Hello, can
Yes,
you hear
please.
me?
I can hear you.
You know, somebody said the network is breaking. So I'm concurring to that actually it was really breaking.
But is it better now? Is
It's
it better
better.
now?
It's better now. We can hear you now.
Oh, please give me 1 minute. Please allow me just 1 minute. Allow me just 1 minute, please. I will. A major concern. Now let's go to the class proper. We explain definition of bond, the characteristic of bond, the face value, the coupon rates. The coupon rate is the interest rate stated on the bond. You can have floating rates, you can have fixed rates, and you can have zero coupon bond. We explain the fixed rate. The interest rate is fixed throughout maturity. The floating rate, this interest rate is not fixed. The interest rate fluctuates in line with change or changes in the general level of interest rates, in the level of market interest rates. We explain zero coupon bond as the bond that pay no interest. Thereafter, we discuss the coupon bond, discount bond, and par bond. Your premium bond, the premium bond, these are bonds with market value greater than the face value. If the market value of a bond is 120 naira and the face value is 100 naira, then such bond will be regarded as a premium bond. We also discuss discount bond. These are bonds having a market value less than the face value. We discuss the par bond. The par bond, where the market value of a bond is equal to the face value of the bond. That becomes a par bond. Thereafter, we discuss the method of valuing bond. Okay, let me ask the class. Do we discuss the method of valuing bond in our last class? Can somebody confirm?
No.
Do we discuss the method of valuing bond in our last class?
No, sir.
No.
No.
No. You were what you did was you talked about the theoretical aspects. Then you talked about Islamic finance. So you had to go through it again because one of us was advised that she wasn't around when Mr. Adejomo treated it. So you had to go through it. So you just introduced.
Sorry to cut you. Sorry to cut you short.
We stopped.
Just one thing. We didn't do bond last week.
We just commenced. We just started it.
Yeah, I want to know where we stopped.
Where we stopped is where you are now. You were trying to explain the different types of bonds that are.
Okay, fine.
You talked about the zero coupon bond and things like that and the terminologies.
No problem. Let me assume that we are discussing bond tonight afresh. Let me assume that we are discussing bond afresh. So I'm going to start the explanation. What is bond? A bond is a debt instrument that establishes a relationship between the borrower and the lender. A bond is a debt instrument that establishes a relationship between the borrower, the bond issuer is the borrower, and the lender. The lender is the investor that invested in a bond. This debt instrument authorizes the borrower to repay the amount borrowed and the interest element to the lender over agreed specified period. All right. Characteristic of bond. 1. What are the uniqueness or what are those things that are peculiar to bond instruments? One is the face value of a bond. The face value of a bond is also called the nominal value of a bond. Sorry for the breaking that. I don't know why this is coming up. But let's continue. There are some occasions I have to go through some unavoidable disturbance. Now let me get back to the business. The face value of a bond is the amount stated on the face of a bond instrument. This amount is usually 100 naira or 1,000 naira. That is the face value of a bond. Please note, where the examiner is silent about the face value of a bond, where the examiner is silent about the face value of a bond, you can either assume 100 naira or 1,000 naira. Number 2, coupon rates. The coupon rate is the annual interest rate stated on a bond instrument. The coupon rate, this is the annual interest rate stated on a bond instrument. This interest rate could be fixed or floating rates or zero coupon bond. Please listen carefully. The interest rates could be fixed. These rates or floating rates. The fixed rate, it means that the annual interest rate on the bond is fixed. Annually, the interest rate will not change. From year 1 to maturity, the interest rate is fixed. You can also have floating rate bond. You can also have floating rate bond. These are bonds with interest rates that fluctuates in line with the market interest rate. A floating rate bond. These are bonds which interest rate fluctuates with changes in the market interest rate. Annually, the interest rate will change in line with the market interest rate. The market interest rate is communicated by the central bank of a country. This rate will always change. That is floating rate bond. We now have zero coupon bond. Zero coupon bond. These are bonds that do not pay interest, that do not pay any interest during their entire life. Zero coupon bond. There is no interest on this bond. If you invest in this bond, you will not receive interest annually. The company will not pay you interest annually. These bonds are issued at a discount. Zero coupon bonds are issued at a discount and generally mature at the face value. Zero coupon bonds are issued at a discount. And this bond will mature at their face value. The return on such bond is called capital appreciation. Return on zero coupon bond is called capital appreciation, which is the difference between the issue price and the face value. The return on such bond is the difference between the issue price and the face value at maturity. All right. Although such bonds are not common, our next discussion we have premium bond, discount bond, and par bond. Premium bond. When the market value of a bond is greater than its face value, such bond is called premium bond. I will repeat that because this topic has relationship with cost of capital computation. The knowledge you are going to get here will have impact on your cost of capital computation. A premium bond. These are bonds with market value greater than its face value. Remember that the face value of a bond is 100 naira. Just like saying you pick your 100 naira notes What is written on the 100 naira note is 100 naira. That amount written on the face is called the face value. The market value is the price of the bond at the capital markets, the current market price. If the current market price of a bond is higher than the face value, such bond is called premium bond, discount bond. These are bonds with market value less than the face value. When the face value of a bond is less than, when the market value of a bond is less than its face value, then such bond will be called discount bond. For example, if the market price of a bond is 90 naira, remember the face value is 100 naira. In that case, such bond will be called discount bond. Then lastly, we have par bond. Par bond. These are bonds with market value equal to the face value. Bond with market value equal to the face value. Please note, a bond may be issued at a premium or at a discount or at par value. Please note, a bond may be issued at a premium or at a discount or at a par value. Also note, a bond may be redeemed at a premium or at a discount or at par. Please note this. Let me explain this with illustration. Let me try to explain this with illustration. Assuming Dangote PSC is planning to raise finance. Dangote is planning to raise additional finance. Dangote can decide to issue a bond. Dangote can approach the capital markets. The bond market operates in the capital markets. Dangote can approach the capital markets to issue bond. In this case, Dangote becomes the issuer, that is the borrower. Dangote can issue this bond at a premium or at a discount or at par value. Now, if Dangote issues this bond investors can subscribe. The same way we subscribe for shares, you can subscribe for bond. The same way investors subscribe for shares, you can also subscribe to invest in bond. Now, the investors are providing, they are providing money to support Dangote business. In this case, the investors are the lender. Dangote is the borrower. All right. So please remember, there are two parties to bond contracts. There are two parties to bond contracts. You have the borrower, the issuer. Then you have the investors. The investors are the lender. Always remember, you may write this down. Also, please remember, from the viewpoint of the issuer, from the viewpoint of the issuer, a bond is a liability. From the viewpoint of the borrower, a bond is a liability. And the interest payable on the bond is an expense. I will repeat that. From the viewpoint of the borrower, a bond is a liability, and the interest payable is an expense. Okay. From the viewpoint of the investors, that is the lender, a bond is an investment, an asset. The interest receivable on the bond is an income. All right. Please note this. A bond from the viewpoint of the borrower and a bond from the viewpoint of the lender. Any question, please? Any question, please?
Hello, sir.
Yes, ma'am. Omawumi.
Yes, sir. Good evening, sir. So I want to know.
It's good to hear your voice.
Yeah, same here, sir. I want to know the difference between this zero coupon bond and treasury bill.
Okay.
Thank you.
First, treasury bill is also an instrument that company can also use to source finance. However, treasury bill is usually on a short-time basis, unlike bond. Now, secondly is most treasury bill will come with interest payments. Most treasury bill will pay you interest. If you invest in your treasury bill, maybe for 3 months, the bank will pay you interest. But if you are talking of zero coupon bond, interest is not paid on zero coupon bond. A debt instrument that pays no interest. Now, what will be your benefit if you invest in this bond? Why will I invest in a bond that will not pay me any interest? Does it make any sense? Now listen to the explanation. This bond will be issued at a discount. For example, Dangote can issue zero coupon bond at a price of 60 naira per bond. The issue price is 60 naira per bond. This bond could be for 5 years. If you buy one bond, if you invest in one bond, you are going to pay 60 naira. But at maturity, the bond will mature at the face value. What is the face value of a bond? The face value is 100 naira. This means that at maturity, Dangote will pay you 100 naira as redemption value of the bond. Remember, when you invest in the bond, you invest at a price of 60 naira. When you are buying the bond, you are going to pay 60 naira. Now, if Dangote is going to redeem, repay your, let me say redeem. Redemption means return your money in 5 years. Dangote will return 100 naira back to you. That means you are now going to get 40 naira at maturity. But this bond will not pay you interest annually. To further explain this, assuming you invest, you purchase like 100,000 bond, you purchase 100,000 units. Assuming you purchase 100,000 units at the rate of 60 naira per unit, that means you are going to invest like 6 million. You are going to invest 6 million in Dangote bond. As maturity, Dangote will now pay you 100 naira per bond. Remember, you have invested in, you chase 100,000 units. Now, you are not going to multiply 100,000 units, multiply by 100 naira. That means at maturity, Dangote will return 10 million to you. Remember, when you invest in the bond, you invested 6 million. At maturity, Dangote will give you 10 million. That means you are not going to have a return. Your return is the difference between the issue price and the face value at maturity. You are not going to have a return of 4 million at maturity. But you must wait for 5 years to get the return of 4 million. So The major point is you are not going to collect interest annually. I hope that point is clear.
Yes, sir.
I
Thank
hope
you.
that point is clear. All right.
Yes, sir. Thank you.
Wow. Just 1 minute.
Hello, sir.
Hello.
Hello.
Yes. He sang.
Yes. Please, sir. Is there any risks attached to this bond? Is there
Okay.
a possibility
Let me quickly answer you.
or anything can happen to the bond that
Is there any risk? All investments involve risk. If you invest in this bond and the company collapses, if the company is liquidated, you might not get your money again. Is that clear, sir?
yes.
So for all investments, there is element of risk. All right, let's move on. Let's go on with our explanation. I'm trying to push this thing up. Now, valuation. Method of bond valuation. Method of bond valuation. The method of valuing bond depends on a number of factors. I will take that again. The method of bond valuation depends on a number of factors. These factors include the types of the bond, the types of the interest rates, and the issuer of the bond. Please, you may note this down. The method you are going to use to calculate the value of a bond will depend on three things. One is the type of the bond involved. You can have redeemable bond, irredeemable bond, or convertible bond. The types of the bond involved. You can have redeemable bond, or the examiner can text irredeemable bond, or the examiner can text convertible bond. Factor number two, the issuer of the bond. A bond may be issued by a corporate company or by the government. The issuer of the bond. A bond may be issued by a corporate company or governments can issue bond. Then factor number three, the coupon rate. The coupon rate could be fixed or floating or zero coupon. These three factors will determine the method you are going to use to value bond. These three factors will guide you on the approach or the method to use when valuing bond. All right. Assuming you are to value redeemable bond. What is redeemable bond? A redeemable bond is a bond with a specific maturity date. A redeemable bond is a bond with a specific maturity date. It could be 5 years, 4 years, 10 years. Redeemable bond. The value of a redeemable bond is calculated as the present value of the expected future cash flows associated with the redeemable bond. I will take that again. The value of a redeemable bond is calculated as the present value of the expected future cash flows associated with a redeemable bond. What are the expected future cash flows associated with redeemable bond? These cash flows are annual coupon interest from year 1 to maturity. The annual coupon interest from year 1 to maturity. 2, redemption value of the bond at maturity. I will take that again. Cash flow number 1, annual coupon interest from year 1 to maturity. Cash flow 2, redemption value of the bond at maturity. Please remember, a bond may be redeemed at a premium or at a discount or at par value. Please note, a bond may be redeemed at a premium or at a discount or at par value. Where the examiner is silent about the redemption value. Where the examiner is silent about the redemption value. You can assume that the bond will be redeemed at par. All right. These cash flows are discounted using the bond yield. These cash flows are discounted to their present value using the bond yield. Number two, valuation of zero coupon bond. A zero coupon bond with a specific maturity date. A zero coupon bond with a specific maturity date. This is calculated as the present value of the bond face value. This is calculated as the present value of the face value of the zero coupon bond. Look at it, please. The price of zero coupon bond is equal to face value divided by open a bracket, 1 plus y, close the bracket, raised to power n, where the letter P is the market price of the zero coupon bond. Letter F is the face value of the zero coupon bond. Your letter Y is the yield to maturity. And the letter N is the maturity of the zero coupon bond. That is the life of the bond. The life could be 2 years, 3 years, 4 years, or 5 years. All right. Number next. Valuation of convertible bond. Remember, please, we have explained valuation of redeemable bond. We have explained valuation of zero coupon bond with a specific maturity date. Now we have to explain valuation of convertible bond. We can now ask ourselves, what is convertible bond? I'm sure we have explained this. Convertible bond. These are debt instruments that can be converted to equity shares. These are debt instruments that can be converted to equity shares. These instruments, a debt instrument with an option to convert to equity. Now, how do we value convertible bond? Please note, ladies and gentlemen, there are two methods of calculating the value of a convertible bond. There are two methods of calculating the value of a convertible bond. Alternative one, valuation as a straight. Alternative one, valuation as a straight debt. This alternative assumes that the convertible bond will not be converted to equity shares. This bond will be redeemed as a debt. Please let us listen to this very well. Valuation as a straight debt assumes that the convertible bond will be converted to ordinary shares. The bond will be redeemed as a straight debt. In this case, the cash flows, the expected future cash flows associated with the bond will be discounted to their present value. In this case, the cash flows associated with the convertible bond will be discounted to their present value. At the required return, using the required return on ordinary debt of the same risk class, deliberately we underline this. The cash flows, expected future cash flows associated with the bond will be discounted to their present value using required return on ordinary debt of the same risk class. Please note that. All right, sorry for, let's continue. Alternative 2, conversion value. Alternative 2, the conversion value. This alternative assumes that the convertible bond will be converted to equity shares. This alternative assumes that the convertible bond will be converted to equity shares. And the value of the equity shares will be calculated. The value of the equity shares can be calculated using the formula below. Look at the formula below. Look at the formula below. Conversion value is equal to PO, bracket open, 1 plus G, bracket close, raised to power N, multiplied by capital letter R. CBN, conversion value in year N. Year N could be 2 years, 3 years, 4 years, or 1 year. The examiner will specify the year of conversion. Your PO is the current share price or the current stock price. What is the current market price of share per share? Small letter n, number of years the bondholder can exercise the right of conversion. The examiner will specify the number of years the debts can be converted to equity shares. Then the capital letter R is the conversion ratio. Number of ordinary shares a bond can be converted to. The examiner must specify the number of ordinary shares a bond can be converted to. All right. Now, please take note of this point. Please take note of this point I'm about to say. Where the examiner provides sufficient information in the question, where the examiner provides sufficient information in the question, then you are going to use the 2 alternative methods to calculate the value of the convertible bond. You are going to use alternative 1, valuation as a straight debt. You are going to get an answer on the assumption that the convertible bond will not be converted to equity shares. Then you are going to get a value as a straight debt. Alternative 2, you are also going to calculate the conversion value on the assumption that the convertible bond will be converted to equity shares. You now calculate the value, the conversion value of the equity shares. You are now going to have two values. The value as a straight debt and the conversion value as an equity. You are now going to select one. You are going to compare the two values. Whichever alternative gives you the alternative that gives the higher value will be selected. The alternative with the higher value will be selected as the value of the convertible bond. The alternative that gives the higher value will be selected as the value of the convertible bond. Any question, please? Any clarification, please? This aspect has been texted and it's always been texted. In 2019, examiner texted convertible bond. It was introduced into cost of capital computation. In 2021, the examiner repeated the same question. Examiner introduced convertible bond into the calculation of cost of capital. And you are required, for you to calculate the cost of capital, you will require the value of the convertible bond. And the examiner keep on saying, students cannot deal with this very well. All right. May God give us a better understanding. The last aspect, valuation of an irredeemable bond. Valuation of an irredeemable bond, a bond without a specific maturity date. An irredeemable bond. These are debt instruments without a specific maturity date. These instruments will pay interest annually, but the principal amounts will not be repaid because there's no maturity period. the debt will not be repaid. The company will continue to pay the interest forever. So, how do we calculate value of an irredeemable bond? This is calculated as the present value of the interest cash flow to perpetuity. I will repeat that. The market price of an irredeemable bond is calculated as the present value of the interest cash flow to perpetuity. There is no specific maturity date. So you now have the interest, the annual interest divided by the discount factor. That will give you the present value of a cash flow to perpetuity. Like I said, it's not a crime if you want to jot down in this class. Because the beauty of online class, and we also have the risk of online class, particularly in the night. You know, for the lecturer may not be able to sleep because you are talking. But the student can just, you can have a student where the student will just sleep off or slept off. You might just be listening to the lecture in your house, in your bedroom, and before you know it, you're already sleeping. To keep us alert in class, you may jot down and even try to ask questions. All right.
Sir, please, can you give the formula again for irredeemable bond?
Okay. Present value of a cash flow to perpetuity. The formula is simply the interest cash flow divided by the discount rate. The interest cash flow divided by the discount rate.
Thank you, sir.
And please, if you want to ask question, and after I might be speaking, you can just signify by raising up your hand so that I can pause. You can ask your question. All right. Let's continue with the class. Yield measure, our next discussion. Yield measure. The yield measures, what is yield? Basically, yield is the return on bond investment. You know, if you are talking of dividends, dividend is related to shares investment. If you invest in shares, The return paid to you as an investor is called dividend. Now, if you invest in bond, the return paid to you is called yield. Bond yield measures. That is the potential return on bond investment or the expected return on bond investments. We have like 3 or 4 types of yield. Bond yield. We have like 3 types. Please just 1 minute. Please for me. All right, let's continue. Nominal yield. Nominal yield. This is the coupon interest of the bond. This is the interest rate. The nominal yield is the interest rate on a bond. Nominal yield. That is the interest rate stated on a bond. The coupon rate stated on a bond. This rate could be 5%, 10%, and what have you. Number 2 is the current yield. The current yield relates the annual coupon interest to the market price of the bond. The current yield relates the annual coupon interest to the market price of a bond. The current yield is calculated as annual coupon interest divided by the market price, annual coupon interest divided by the market price of a bond. Everything multiplied by 100. This yield measures the current income from the bond investment as a percentage of the market price of the bond. This yield measures the current income from the bond as a percentage of the market price of the bond. The current yield is important to income-oriented investor. It stands to income-oriented investor who wants current cash flow from their investment portfolio. Explain that. Income-oriented investors. These are investors that are interested in monthly or annual return on their investment. These investors are called income-oriented investors. So the current yield is important to income-oriented investors. Current yield is of little use. Yield is of little use. Please, as much as possible, because I can't remember now. About 45% of your question will be in written form. In recent time, just go back to past question. You see the examiner asking, explain this. Like last diet, examiner texted conflict between bondholder and shareholders, 8 marks. What I'm trying to say is, you can pass this exam even at a sitting. What you require is to try and identify your own strengths. For some students, they are very good with calculation. For some, they have strengths in theoretical area. Try to identify your strengths. Understand your limitation, your weaknesses. The strategy will be, please focus on while you work on reducing your limitation or your weaknesses. All right, that is by the way. The current yield is of little use because it does not consider the capital gain or loss that a bondholder will realize. Capital gain or loss that a bondholder will realize. The bond is purchased at a discount or premium and edged to maturity. If you purchase a bond at a discount, then you are going to have capital gain. If you purchase a bond at a premium, then there could be capital loss. So the current yield does not consider the capital gain or loss that a bondholder will realize if the bond is purchased at a discount or at a premium and edged to maturity. Also, the current yield ignores the time value of money. So this yield is of little use. It is only used by income-oriented investors. Number 3, maturity, in brackets, YTN. The yield to maturity, in brackets, YTN. This is the most widely used bond yield measure. This is the most widely used bond yield measure. The yield to maturity considers the interest income, the capital gain or loss, and also the time value of the cash flow. the time value of the cash flows. Ladies and gentlemen, yield to maturity is to bond. What internal rate of return is to capital projects. I'm trying to emphasize a key point here. You know, if you see me breaking into, ladies and gentlemen, I'm trying to draw the attention now. The yield to maturity is to bond what internal rate of return is to capital projects. Yield to maturity is calculated by trial and errors. In the same manner, we calculate internal rate of return. Recall, if you are trying to calculate internal rate of return, you are going to assume a discount rate that will give you positive NPV. Then assume another discount rate that will give you negative NPV. You now use this information to interpolate, to calculate your internal rate of return. The same method is used when calculating YTM. We are going to get, in other words, the yield to maturity is the internal rate of return of the cash flows associated with a bond. In other words, the yield to maturity is the internal rate of return of the cash flows associated with a bond. All right. My next discussion. Assumption of YTM. Please listen to this also. Assumptions of yield to maturity. 1. All coupon interest can be reinvested at the YTM. It assumes that all the coupon interest can be reinvested at the rate of YTM, the yield to maturity. This reinvestment assumptions implies a flat yield curve. If you invest, it must be at the rate of YTM. It will change. Number 2, the bond is held to maturity. For you to calculate yield to maturity, that means the bond must be held up to the point of maturity. Then number 3, all coupons are received in prompt and timely fashion. All right. Let me tell you what happened in 2023. I think November dies. Examiner tested this assumption. Examiner said in that question, students were asked to calculate the yield to maturity. That is the part, that should be the part A of, or the part B of the question. Examiner says calculate the yield to maturity of the bond. Now the C part now says explain why the investor may not realize the yield to maturity. The examiner now say explain why the investor may not realize the yield to maturity. If you now want to respond to that question, what are the likely reasons why the investors or the investor may not realize the yield to maturity? The reasons are if these assumptions fail to hold. For example, if the bond is not hedged to maturity, then you cannot realize your yield to maturity. Number two, if the annual coupon interest are not received promptly, maybe you are supposed to receive your interest on 31st December every year. You are supposed to receive interest 31st December every year. If the company fails to give you the interest on 31st December, and the company is now paying you like March of the following year, that means your coupon interest are not received in prompt and timely fashion. In this case, you may not realize the yield to maturity. Then number three, if the coupon cannot be reinvested at the rate of the YTN, then the investor will not realize the YTN. Is that clear, please? The examiner is trying to be tricky. If the examiner has asked students, what are the assumptions of YTN? Let's just answer directly. But the examiner now says no. Calculate YTN. That is the part B. When we now get to part C, the examiner now says, explain 3 reasons why the investor may not realize the yield to maturity. May God give us a better understanding. Please, you must be able to interpret question out. All right. It's apparent I can't solve any question, but we shall round up the explanation. Bond duration. All right, before I go to this, any question, please? Any question?
I think when we solve the question on the
okay, no, sir, I'm even missing you.
Yeah, I'm saying, sir, that when we start solving the questions, then all these formula, they will come to life, because now it's so theoretical. Like this yield to maturity formula, it won't be fully appreciated until we start solving questions. Yes.
No problem. God will keep us, God keep us alive and in good health. Somebody is touching my screen.
Hello.
Please don't touch my screen. That is Uzeni, you are touching my screen. All right, let's go to his duration. Bond duration. What is duration? Duration is the measure of the average life of a bond. The bond duration is the measure of the average life of a bond. It is defined as the weighted average of times until each payment is made, with weights proportional to the present value of the payment. Duration measures the sensitivity of the bond price to changes in interest rates. Let's try to simplify that. Duration tries to measure the extent to which bond price or the bond market price is sensitive to change in interest rates. If there's a change in interest rates, what is the impact on the market price of the bond? This is what duration tries to measure. The sensitivity of a bond price to change in interest rate. The higher the sensitivity, the higher the duration. Again, you can explain duration as is a measure of how long an investor in bond will realize the amount invested in bond. Duration is the measure of how long a bond investor will wait before realizing the amounts invested in bond. This is very similar to payback period. If I invest in this bond, how long will it take me to recoup or recover the amount invested in the bond? So technically, duration is like payback. Steps involved if you have to calculate duration. Step 1, calculate the YTM. Calculate the yield to maturity of the bond. Step 2, use the calculated YTM to discount the cash flow from the bond. Use the calculated YTM to discount the cash flow from the bond. Then the last step, use the notation below to calculate your duration. The notation below is summation present value multiplied by n divided by the summation of the present value. when we get to question, it's just that tonight, I'm not likely to enter question. Significance of bond duration. Like we explained, duration of a bond is an indication of the price sensitivity of the bond to change in market yield or market interest rates. A rise in interest rates, if the interest rate rises, the market price of the bond will fall. Please listen to this principle. If the interest rate rises, if the market interest rate increases, the price of a bond will fall. However, a bond with longer duration will experience greater fall in market value compared to a bond with shorter duration. When we get to question, I'm going to refer you back to these points. In summary, duration can be used to compare bond with different coupon rates and maturity period. Duration can be used. Duration allows bond with different coupon rates and maturities to be compared directly. Investors can use this to determine the risk involved in bond investments. You can use duration to determine the risk involved in your bond investment. If you have to decide whether to select bond A or bond B, you can use your duration to determine which bond to select that will minimize your risk. All right.
Yeah, this line, that first line, I know that it's premature to be asking a lot of questions. That when we're solving questions becomes clearer. The duration
Yes,
of
no
a
problem,
bond,
no problem. I
yeah,
also expect it.
The duration of a bond is an indication of the price sensitivity of the bond to a change in
Yeah,
market yields on the
the duration
so
of a bond.
it's not too clear.
Okay, let me go to that. The duration of a bond is an indication of the price sensitivity of a bond to change in market yield. Let me explain that. When we say market yield, market return, or market interest rate,
Okay, I
the
understand
duration
that.
of a
Yeah.
bond is telling us the extent to which the price of a bond is sensitive to change in market interest rate. Is that clear, sir?
Okay, I understand the relationship. Just that because the duration, when we went, if you go up a little bit, when you try to define what duration means, I think we're talking about how long will it take to recoup the investment in the bond? That is the duration.
Okay, so let me ask you. If you invest in bond, what is the return to you? The interest you receive
There are two
annually.
aspects. Yes, the interest and whether the bond itself has appreciated, I think.
In value, good. So if your return is in form of the interest received annually,
yes.
You now ask yourself, if I receive interest in year 1, year 2, year 3, and of course, as I get the interest, you are not pulling the money out. You also reinvest the interest. You know, you don't collect the interest annually. It's like compounding interest where you reinvest it. Now, how long will it take you to recover the actual amount invested in the bond? Now, if there's fluctuation in market price, if there's fluctuation in interest rate in the market, it will have impact on your bond. And that will have impact on the capital appreciation.
Yes.
All right. Like you said, there may be several questions, but for now, the focus is past the ICAN first. Is that clear, please?
Yes, of course.
The focus is past your ICAN first. Because someone like, do I even need this thing? Do I even use it in my office? If you don't find yourself in capital markets, you might not even be doing this in your office. So, but you require the knowledge to pass your exam first. So let's move on. So let's move on. All these are just, yes, they are good. Characteristic of duration. One is that duration is inversely related to YTM. Listen. Just 1 minute. Go with the class. Let's go on with the class. Yes, any question?
No, we didn't hear you for a while. That is why.
Oh, sorry. Now I'm trying to explain the characteristic of duration. One, duration is inversely related to YTM. The higher the YTM, the lower your duration. When we get to computation. Number two, duration is directly related to the coupon rates. The higher the coupon rates, the higher the duration. Number three, duration is directly related to the maturity days. The longer the maturity, the longer the duration. Duration of a zero coupon bond is the same as its maturity days. The duration of a zero coupon bond is the same as its maturity days. The duration of a perpetual bond. What is perpetual bond? Irredeemable bond. Till perpetuity. Perpetual bond is an irredeemable bond. This is calculated as 1 plus y divided by y, where your y is the yield to maturity. Level annuity. A level annuity is a redeemable bond with a fixed interest rate. This formula is just for us. I think we have with this. Modified duration. This is closely related to duration. The concept of modified duration is given as MD, modified duration, is equal to duration divided by 1 plus the yield to maturity. Your duration divided by 1 plus y will give you the modified duration. What is the importance of modified duration? Why are we interested in modified duration? Modified duration is used to estimate approximate change in the price of a bond. Where there is a small change in yield, modified duration is used to estimate approximate change in the price of a bond. Where there is a small change in bond yield. So if I want to know if there's an increase in interest rates, I can estimate percentage change in the price of the bond. I can use modified duration to estimate the likely change in the market price of a bond if there's a change in interest. All right. We have credit risk, credit spread. We also have credit rating. What is credit risk? Let me explain this on this angle. You can have corporate bond. You can also have government bond. A corporate company can issue bond. That becomes corporate bond or commercial bond. You can also have government bond. Remember, government bond is regarded as risk-free. Government debt instruments are regarded as risk-free. But corporate bonds are not risk-free. When we say risk-free, It means that if you invest in government bond, government has the capacity to pay you the annual interest and the principal repayments. If you invest in government bond, government has the capacity to pay you the annual interest and the principal repayment because the government will not liquidate. So government bonds are regarded as risk-free. On the other hand, companies' bonds are not risk-free. Now, what is credit risk? This is the risk associated with corporate bond. Credit risk. This is the risk associated with corporate bond. The risk that a corporate bond, the company may fail to pay the annual interest and the principal repayment on schedule. That is the credit risk. This is peculiar to companies' bond. And this is why companies' bond will pay higher interest compared to government bond. Government bond will always pay low interest rates. If you invest in government bond, that means you are investing in a risk-free asset. And the interest payable is usually low. But if you invest in companies' bond, because there is element of credit risk, then companies' bond will pay higher return. For example, if government bond is paying 3% or 5% interest annually, companies' bond may pay like 9%. That means companies' bond will pay higher interest to investors to compensate the investor for the risk involved in corporate bond. We now have credit spread. When we say credit spread, let me also explain. Look at the example I gave. The interest rate payable on corporate bond is 9%. While the interest rate payable on government bond is 5%. The interest rate payable on companies' bond is 9%. While the interest rate payable on government bond is 5%. The difference between the two, 9% minus 5% is 4%. That 4% is called credit spread. In other words, credit spread, this is the additional return payable to investors in corporate bond. The credit spread is the additional returns payable to investors in corporate bond to compensate them for the credit risk involved, for the credit risk of the corporate bond. So don't forget, please, credit spread is the additional return payable to investors in corporate bond to compensate them for the risk involved in corporate bond. Yield curve. Let me explain it in summary. The yield curve is the yield curve shows the relationship between the interest rate payable and the maturity period of a bond. The yield curve shows the relationship between the interest rate payable the maturity period of a bond. You can have, okay, before I go to that, generally, the longer the maturity, the higher the interest rate payable. Generally, the longer the maturity, the higher the interest rate payable. For example, if you invest in a bond for 1 year, maybe the interest rate may be like 2-3%. 2 years, the interest rate will rise. The longer the maturity of a bond, the higher the interest payable. So the interest rate is not flat. The yield is not flat. It's a curve-like. Okay, now you can have two types of yield curve. Government yield curve and corporate company yield curve. You can have two types of yield curve. Government spot yield curve. Government spot yield curve. This shows the relationship between interest payable and the maturity date of a government bond. Let me repeat that. Government spot yield curve shows the relationship between the interest payable on government debt or government bond and the maturity period of the government bond. Please note, government spot yield curve can only be used to value government debt instrument. Please note, government spot yield curve can only be used to value government debt instruments. Next, please note also, if you are asked to value corporate bond, if you are asked to value corporate bond and you are giving government spot yield curve, this yield curve cannot be used directly to value corporate bond. The government spot yield curve cannot be used to value government bond directly. You have to adjust this government spot yield curve with the credit spread of a corporate company. Government spot yield curve will be adjusted by the credit spread of a corporate company. This will now be used to value corporate bond. So I'll round up the class now. Your credit rating. What is credit rating? What is the importance of credit rating? Companies' credit rating. Some of us, you may have noticed, companies are rated AA, single A, double A, triple A's, B, C, D. Why credit rating? Credit rating is carried out by recognized rating agency so as to determine the ability of a company to obtain loan and make repayments. It shows the capacity of a company to obtain loan and pay back as at when due. And this will affect your credit rating, will affect your cost of borrowing. It's like saying Dangote want to borrow money. Some bank can give Dangote loan at 1% rate. That we are sure that this company has capacity to pay back. It will affect your cost of borrowing. And it can affect your cost of bond. Interest on bond. So what are the factors we consider that can affect companies' credit rating? What are the variables that can affect a company credit rating? One is the firm size. The size of a firm can affect its credit rating. If you look at multinational companies, multinationals, they may enjoy positive credit rating. Number two, your financial gearing. The extent to which a company has borrowed money. If a company is too geared or highly geared, that can reduce the company's credit rating. The risk characteristic of the firm or the industry, we call it industry-specific risk. The industry-specific risk can affect a company's credit rating. We also have country-specific risk. It's like operating business in Nigeria come to operating business in US. Nigerian business environment and the business variables are very dynamic and highly unpredictable. The Nigerian business environment is highly unpredictable compared to operating your business in UK. So country-specific risk will affect the company's credit rating. We also talk of the perceived strength and management of a company, meaning the quality and competency of a company's management. We have impact on the company's credit rating. All right. It's obvious that we can't drive calculations tonight. But please, to help the class, to also help me, so that if I'm able to address 2 questions next week, is for the good of this class. Please let us watch the video often to prepare ourselves against calculation next week. Any question, please? Any question, please?
Hello, sir.
Yes, ma'am.
This rating, the credit rating, that means the higher the rates, the higher the ability for the company to be granted a loan.
Yes, please. Very correct. If you are rated A, If your company is rated AAA, that means your company is top rated. So you are very correct, please. Any other question? All right. Let's have a blessed evening. May God give us a better understanding. I will be checking out of the classroom. Good night and remain blessed.
Thank you, sir. Good night.